You probably heard that you need a trading plan before you start trading, but how exactly do you go about crafting one? Now, if you have ever tried to start a business, you will know that you need a business plan which tells you the A to Z of everything you need to do for your business, the step-by-step process you're going to execute your plan, your strategy and all that. So the same thing applies to trading. You need a trading plan before you start trading. So in this video, I'm going to show you how you can craft the perfect trading plan. Hi, this is Spencer from Synapse Trading, and today I'm going to share with you the 7 key ingredients that you need to craft a winning trading plan. Number 1, the trading style. The first thing you need to do is to determine what is your preferred trading style. Now there are 3 main types of trading styles: day trading, swing trading and position trading. The main determining factor would probably be the amount of time that you can afford to spend on trading. So if you are doing it as a full-time job, or if you have a lot of time to spend, then you can probably consider trying day trading. And if you like the fast-paced environment and making quick decisions, then that may be something for you. On the other hand, if you're just doing it as a part-time endeavor, where you have maybe an hour or 2 a day to spend on trading, then you might consider swing trading instead, where you take longer term positions, right? More on the medium to long term positions instead of going in and out of the market, such as like in day trading. Lastly, if you do not have much time at all to spend, then probably the most effective thing for you to do is position trading, where you take long-term positions that could be that last weeks or months. So this does not require you to spend a lot of time analyzing the charts on a day-to-day basis. Now the second factor to consider is the time frame. Now this corresponds closely to the trading style that you choose. For example, if you are day trading, most likely you'll be using an intraday time frame, such as the 5-minute chart or the 15-minute chart, or even the 1-hour chart. On the other hand, if you are swing trading, most likely you'll be using a time frame such as the hourly chart, the 4-hour chart, or the daily chart. And lastly, if you are doing position trading, which is a long-term endeavor, you'll probably be using daily chart or the weekly chart or even the monthly chart. The third major ingredient is the product. Now this is the trading product that you are choosing to specialize in, right? So for example, it could be things like forex, stocks, bonds, commodities, derivatives, cryptocurrencies, options, right? So there are actually many different products. So you need to find a product that kind of suits your trading style, suits your personality, something that you are going to be familiar with, right? So I'm not going to go into that much detail in this video, because there'll probably be other videos that cover each product in more detail. Number 4, risk management. Now this is the part that determines how you allocate your resources. So for example, one thing to note is your starting capital, which is the amount of capital that you are going to start with, because this will determine your trading size and the risk that you're going to take for each trade. So for example, a common calculation is to risk 1 to 2% of your capital per trade, depending on how much risk you want to take. If you are starting with $10,000, then you will probably be risking 2% of $10,000 per trade, which is about $200 a trade. And the other thing you need to take note of is the open risk on all your trades. If you are risking say 1 to 2% on each trade, you need to ask yourself, what is the maximum risk or maximum drawdown that can happen if all the positions that you have open at one time all get stopped out instantaneously, right? So when that happens, what is the total amount of risk, right? And that is known as the open risk. You're risking 1% a trade and you have 5 trades that all go sour at the same time, you lose 5%, right? So 5% is your open risk. So you want to limit your open risk to less than 5%, because you don't want to lose a large chunk of your capital at the same time. It's ideal that you have a limit to the monthly drawdown that you incur, because you don't want to have a scenario where you lose a large chunk of your capital in one time period, because if you lose too much of a capital in 1 month, in the next month you have no more capital to trade. If you are not doing well this month, it will be ideal to perhaps take a break from trading and you can come back to fight the next month. The next major category to look at is the type of analysis that you are going to be using. Now, there are three main types of analysis: price action, classical charting, and technical indicators. Now, each of these is a complex topic that I've created other videos on. So the main thing for you is really to decide like which one you are going to specialize in. But most of the time, as a trader, it's important to actually learn and master all the three different techniques, because you're going to use them in combination in certain ways, and that actually leads you to formulating your trading strategies, which is number 6, the type of strategy that you are going to be using. Now, personally, I feel that most trading strategies will fall under 4 main categories: breakouts, trend following, counter trend, and market reversals. So if you look at your strategy, you want to be able to see which category it falls under, so that you can better understand what are the strengths and weakness of each strategy, right? So I do have videos that cover in detail also what are the different strategies that I use. So breakouts is when price breaks to new highs or new lows. Trend following is more like finding an opportunity to ride on a strong trend, a strong trending market. So usually you'll look to enter on pullbacks. Counter trend trades are usually opportunities where the market has gone to certain extremes, like it's too overbought or too oversold. Knowing how to pinpoint and target those counter trend moves, right, is the essence of counter trend trading. Lastly, market reversals are like the big kind of reversals or turns in the market that do not happen that frequently, but when it does happen, you want to be aware, because it leads to a change in the major trend. The final and 7th ingredient is the trade execution. Now, there are 3 key parameters that you need to determine before you decide to enter a trade, and that is the trade entry, the stop loss, and the target price. Now, the trade entry is the price at which you are going to enter the trade, and that is determined by the strategy and the setup that you are using. The stop loss is the price that you are going to get out of the trade. So a stop loss is there to protect and limit, right, the amount of loss that you are going to incur on the trade. So there are certain types of stop loss, such as the fixed stop loss, the trailing stop loss, and all this should be part of your trading plan. And finally, the last thing is the target price, which is where you are going to take profit on a trade if it does go in your favor. So you need to have certain preset rules. For example, how are you going to project a target price, or how are you going to determine where is the optimal point to scale down your positions or to get out of the position totally. Now that I've covered the 7 key ingredients to a winning trading plan, there's some other things that you might want to include as well. For example, evaluation metrics, to how you're going to measure and improve the performance of your trades, and as well as trading psychology rules that you can implement to prevent you from making cognitive biases or mistakes in your trading. So remember that the key purpose of having a solid trading plan is to separate the execution phase from the planning phase. So ideally, the moment the market opens, you are focused on executing your trading plan, and you no longer have to strategize, because if you are trying to do both at the same time, it is going to be really difficult to concentrate. Therefore, that is the idea of a trading plan. Now that I've shared the key ingredients in my trading plan, what are some of things that are missing from your trading plan, or things that you think can be improved on? Do let me know in the comments below. And if you do enjoy this video, do like or subscribe, and do click on the bell notification for future updates. That's it for this video, and I'll see you in the next one.